All right, you guys, this is being recorded, and one thing I talk about at the beginning of all these webinars is to watch it again so that you guys can get all of the nuances that may fly by you the first time. It'll also make it sink into your short-term, or from your short-term memory into your long-term memory. Little flustered after the first crash. Anyway, my name is Eric Wilkinson. Some of you may recognize me from CNBC, Fox Business, the Wall Street Journal for commentary on everything from economic to geopolitical market analysis. I started trading in college with a psychology degree, which probably served me better than my financial degree that I ended up switching over to because I started trading and kind of fell in love with it. After graduating from college, I moved up to Chicago and just walked onto the floor one day and got a job as a runner, moved up into the pits and started trading. So in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of these products, and basically all market conditions. As you can see, this was a fun day. Anyway, I got to go over this disclaimer really quick. Any opinions, news, research, and analysis or other information contained here are material provided by ProTrader Strategies and associate companies or employees is provided as general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategy. Basically, in a nutshell, what this is saying, you guys, is I can't give you financial advice because I don't know what's in your portfolio and I don't know your risk parameters. So at the end of the day, we're trying to teach you these different strategies because I believe they're extremely important in lowering cost basis on stocks or really using margin in order to achieve more yield, which is basically alpha or higher profit potential in a sense. And bottom line is, do your own homework. Remember that past performance of any trading system or methodology is not necessarily indicative of future results. A couple of questions thrown at me right away. Why did they make you wear the yellow uniforms? Well, at the Merc, I was at the Board of Trade, Chicago Board of Trade. So we did the blue and the white. I came up with that design because it stuck out against what everybody else in our pit was wearing. In the Merc, only members could wear their own kind of jacket, their style of jacket, like mine was the yellow and blue. But at the Board of Trade, our clerks could wear that, and that would kind of signify our group, if that makes any sense. At the Merc, only the members could wear it, and all you saw were the manila colored jackets, which I never really understood, to be quite honest. And why are you called the Wolfman? I'm called the Wolfman because I used to do stuff with Rick Santelli. If you don't know who Rick Santelli is, he and I used to have big debates off the floor, or off screen, I should say. And then he said, hey, set up the camera, and Wolfman, or this guy, Eric, and I will start having banters back and forth, kind of add some light to it. And Joe Kernan, who did the morning show that early in the morning, like before 7 o'clock or something, just started calling me Wolfman. And another little tidbit, Joe Kernan and I actually have the same birthday. So there you have it. You can follow me on Twitter at Wolfman's Blog. I don't know if you guys have been following me, but I've been throwing out some of the earnings trades that I do. I usually don't throw out any other trades other than earnings because I talk about those in the daily market commentaries. So the earnings trades, though, since I do the morning commentaries in the morning, and I put on these earnings trades that we're going to be talking about today in the afternoon. So, within the last hour or two of the trading day is usually when I put those on, so I can get a clean number. So that's why I will throw those out. I won't always say exactly what the strikes are, but after doing this webinar, you will know exactly where those strikes are. And you can follow us at ProTrader Strat for some Monday motivation or Wednesday wisdom, stuff like that. All right, so this is going to be on earnings setups, like I mentioned earlier. I think maybe during the crash of my computer that we had done the first segment on calls and call spreads. Then we went on to puts and put spreads for directional assumptions. Now, this is going to be more along the lines of a neutral market assumption. And in a sense, we're going to be jamming those last two together and creating a strategy called the strangle. We can look at straddles. I don't usually use the straddles though for earnings because I'm expecting a bit of a move, and I usually like to be outside of the market maker move, whereas the straddle kind of puts you with this move being inside the market maker move. So it's really kind of up to you. I will talk about it, but I'm probably going to go into more detail about the strangle. Now, why do I love these earnings trades? It's because of volatility collapse, or what we used to call on the floor the crush. It's anytime you saw volatility just fall out of bed, and I'll show you a couple charts of how volatility crushes. And the great thing about that as an option seller is that you know exactly when the premium's coming out of it. Now, we can talk about theta decay and things of that nature, but volatility crush is really what determines those premiums. And when that volatility comes out, those premiums just deflate rather quickly. So, and you know exactly when that timing is going to happen. And makes it more fun, I guess, and more profitable. Theta contraction is another thing we're going to be taking advantage of, because with these earnings trades, we'd like to get all of this happening at one time. And if we go real close to the expiration with these, which if you watch any of my normal webinars on regular strategies and trades, things of that nature, I like to get out when selling strategies about 25 or 35 to 45 days to expiration, and then be out well before the time of what we're going to be talking about for this type of trade. But this, we want to have a lot of theta contraction and take advantage of that known volatility crush. What do you mean by you know exactly when the timing happens? Well, going into a binary event, we get volatility increasing. Anytime, so let me go a little further back here. So a binary event, you guys, really is any known event that there's going to be news about. For the Fed fund futures, which is what I used to trade, futures and options and Fed funds, we knew when the FOMC date was, right? So going into that event, that was a binary event, the meeting, whenever they released what was going to happen, volatility increased during it. In the grains, the same thing happens with the WASDE report, which is the grain report. Volatility increases going into the WASDE. In stocks, it is the, generally speaking, there's more than just one. I mean, volatility will increase for, say, maybe the banks around the FOMC meeting, but a binary event for stocks is the earnings release. And so volatility increases into that. Volatility is really a fear indicator in a sense. So, if there's fear around a known event, volatility is going to increase. After it's known, there's nothing really to worry about. We already know. So that volatility really crushes. So we know that around these type of events, volatility is going to crush. And another thing is I've heard people talk, like Goldman Sachs one time, I read an article on them, it's talking about buy calls going 5 days in front of an earnings event and sell them out the day after. That makes no sense at all, you guys. I hope you don't listen to those people. If you bought it 5 days in front of it, I would hope you would sell those calls no matter if you were profitable or at a loss heading into that event, and not wait through that event, because that volatility crush, you could be directionally right and still lose money. So, and I'll show you that here in a little bit, a couple of examples of that. But that's what I mean by we know volatility is going to collapse after the binary event. And, is it 100% of the time? I probably shouldn't lead you to believe that, but I would say it's well into the high 90 percentile of there being a volatility crush happening after the event. All right, so just to recap what we I've already jumped around, I guess, a little bit, but we talked about the bullish strategy, which would be selling the naked put or creating a put spread, the bearish event, selling calls or selling a call spread. Now we're going to be talking about these neutral ones. And I mentioned the straddle and the iron butterfly, which is a straddle and an iron butterfly. The only difference there is the straddle is naked, the iron butterfly is defined risk. So, but I really like to go with the strangle and the iron condor. That's just my preference. I think that there's a higher probability of success with the strangle and the iron condor than the straddle or the iron butterfly. It's just earnings events have a tendency to move outside what you can collect for a straddle a lot of times, so it just makes it very difficult, and there's a lot more risk at bay, because if it does move outside the market maker move, you're going to really start being hurt rather quickly. All right, so a couple of things. The strangle is going to be a short call added to a short put. I'm going to go over all the risk and things of that nature here in a second. But if we wanted to do the iron condor, we basically add a call spread with a put spread, or it's a strangle with defined risk. Same thing with the iron condor and the iron butterfly and the straddle. Straddle is basically the two at the money strikes, the call and the put, and then to define that creates that iron condor. Or sorry, excuse me, straddle with defined risk creates the iron butterfly. All right, so like I mentioned, I'm not really going to talk a whole lot about the straddle and the iron butterfly, because I just think that, especially if you're watching this, it'd probably be a very early time to put on that much risk, and the market has a tendency to move a little bit more than those, so to me it's not going to behoove anybody to do that at this point in our lives. But anyway, the essentials to success: picking the right strike. We have to know where our risk lies in order to pick these strikes, and the best way to do that is to come up with the market maker move. Now, Thinkorswim does a great job up here at the top showing where the market maker move is. If you've ever if you use Thinkorswim, this is the market maker move, and it's actually like just a couple of I think it's just 3 M's right there, but that's the market maker move for Thinkorswim. They give that to you. The other thing is, keep in mind this number down here. If you hear me talking about IV percentile, we want to be in earnings with high IV percent. Now, this isn't as hard fast of a rule here on the above 50. I definitely like it because it gets me further away, gets me away from the market. The higher the IV percent is, the further away you are from the market. It just, as the premiums inflate, it means you can get further away. But having said that, if you really love the stock and think that it's just not going to go anywhere or something like that, you're still going to be able to take advantage of that implied volatility crush. And one cheat, I guess, if you will, to figure out what the implied volatility crush is going to be, you guys, is look right here. So Pepsi, you guys watched yesterday, this was a snapshot of yesterday. So Pepsi came out. It was supposed to be a $2 expected move. So one could expect volatility. You know, volatility is at its highest where the earnings are going to be released. So it's at 26.85. We call it 27 for math purposes. This is how you know there's where the volatility is going to crush to. Now, it's a ballpark figure, but it gives you a pretty good estimation as to how much it's going to crush. And we could do the math on it. I'm going to ballpark it in my head and say it's almost 50%. You know, it's probably closer to 40-something%. So we could assume that after the meeting, after this event, this volatility is going to drop by 40%-ish. I can do the math for you. I mean, you could punch it up on a calculator and figure out how much of a percent it is, but I'll just do that real quick. 27 divided by, what is it, 17? Oops, actually 17 divided by 27. So yeah, it's about a 38%. I was doing it in my head. So basically just take the 17 divided by 27. Oops. By 27. Gives you 63%. So that means it's going to crush by about 37. Yeah, 37. All right. So, and we can figure out a couple other things with that, but that's a good thing to look at. Like, how much is the market expecting that volatility to crush? And that's a good, ballpark figure the day before to give you an idea. Did you say adding a leg makes the straddle risk defined as a butterfly, as an iron butterfly? Yeah, the straddle with defined risk is an iron butterfly. A butterfly is either all puts or all calls, and an iron butterfly is a call spread and a put spread, but the short strikes are at the money. Okay, this is another way to figure it out, and this is what we used to do on the floor because we didn't have the fancy trading platform and having TOS give us this information up here. But another quick way to do it, and all of that is estimation, you guys, with the market maker move in a sense. I mean, it's basically plugging in and out numbers from the Stoudemire theory. One other thing I did want to mention is going back here. This is also what the market's expecting the underlying to move as well. This in parentheses, plus or minus $2.49. But keep in mind, that's all the way until expiration 3 days later. This number up here gives you the number estimated for after the binary event, after the earnings event in this case. All right, but what we used to do on the floor was we would take the at the money straddle and multiply that total price by 0.85 to get what our estimation for the market maker move is. And how is it all figured out? Basically, it's the calculation is the trade price where the underlying is trading times ID and divided by the square root of the number of days in the year, or like 19.105 or something. So if you guys want to punch all that into your computer or just multiply it by 0.85, then that's up to you. I prefer this way. It's a little easier. How is Id percentile calculated? Great question, David. I'll show you that in a minute, and when I start talking about the chart of IV, that's what I'll kind of tell you about that. Back to this. So this is a snapshot of JP Morgan. This is another earnings that happened last week. So what we can do is look at this one and zero out my, so when we're talking about getting the market maker move, they're saying JP Morgan the next day was going to have a plus or minus move of $1.73. Again, you can see that this is a little bit off, even though it's only 1 day to go. That's why it ends up being all kind of an estimation in a sense. But we can look at it 1 day to go. We look at 123 plus 77. We can take that and give us $2 move, right? So $2 times our 0.85. And it should give us very close to that. 1.7 is what mine is. I will tell you the 0.85 is usually a little bit tighter than what theirs is. But at the end of the day, I'm going to round that up 30 cents and be looking for my market on like a $2 move on something like that. So I always try and round up to the whole number. I never round down, so always just round up. Even on this number, I would have rounded that up to $2 and start working from there for the most part. Or we're going to be looking, it ends up being this 16 delta most of the time. So like, for instance, if we added $2 to this, that puts us just outside is 88. So that's what we're looking for. It's predicting around a 87.5-ish with all the market maker move stuff, and we get outside of that to start selling. So I would have sold either one of these two. I probably would have defaulted to the 21s because I like to collect somewhere close, at least very close to 30 cents on either side. So I probably would have had to go down to the 21s on this particular montage. And if I ever say montage, you guys, montage just means this whole screen is an option montage. All right, so where do we find our basis to start building this strategy? Well, we're going to look at, this is a standard deviation curve, and standard deviations actually line up with deltas. So for instance, if we add up all these percent probabilities, we add 13.6 to 2.1 to 0.1 and then add those up, it comes out to very close to 16. So a 1 standard deviation move to the put side or to the call side is a 16 delta, because you're adding up all of these here and all of these here, and the probability is that we will land within this area. Okay, sorry I went a little bit far, but that's what we're looking for it to happen. And the reason why we're looking for it to stay inside of that market maker move, because remember I was talking about volatility being a fear indicator in a sense, and fear has a tendency to get over exaggerated. You know, I mean, people's fear always seems to be worse than what it is. A fear of spiders or something like that. You know, spiders generally not going to hurt you, but some people are very fearful of clowns. You know, some people are very fearful of clowns, but that's how fear has a tendency to take over some of our emotions, and it's overdone in a sense. So that's what same thing happens with the markets, as people pump up volatility when they're nervous because they're buying puts to cover themselves to the downside, and that inflates premiums. So we try and take advantage of that. One standard deviation is a 16 delta. That means it is a move from the current underlying price to a 16 delta price. Yes. Can we see an illustration on the montage? Thanks. Yes. So for instance, so we just added these up. 13.6 is 15 point, and 2.1 is 15.7. That's 15.8, right? So that's close enough to 16 for government work, right? This is the 16 delta right here. See that? 16 delta for the calls and 16 delta for the puts. But now I defaulted to rolling it down just a little bit to the 17s, because I like to collect 30 cents at a minimum for the most part, because after commissions and everything else, I don't know if it ends up being worth it, but usually I like to try and collect at least around 30 cents for something that's under $100 for the most part. You know, if I was only going to be able to collect 30 cents for these right here that are just out of the money, so I did it a little bit high, but any one of these, you know, say that was only 30 cents, I might look to just sell the straddle at that point. But usually around these kind of events, we have pretty high implied volatility, and it will have a tendency to get us further away from the market. Now, if we're looking at doing a iron condor, okay, one of my rules is to collect a third the width of the strike. So of the strikes, I should say. So if it's $1 wide, I'm going to look to collect at least 30 cents. If it's $5 wide, I'm going to be looking to collect about $1.80, because 5 times, or $1.50, I should say, $1.33. So somewhere in there, right? So yeah, so about $1.50 for a $5 wide. And so just kind of judge it by that. Just think, you know, a third the width. So if we're going to collect a third the width, what that's usually going to do is drag us into about a half a standard deviation move, which if we add up all of these, remember we had 15, well 16, that puts us right around, this is a 15, I know it's hard to read, but that puts us around a 31 delta. So we want to do something around a 31 delta. So we'll work on that. No, 3 standard deviation move is a 0.1 delta. Yeah, sometimes there will be tail, you know, there's going to be skew. This is, and it's usually skewed from the put side. Like puts have a tendency to get pumped up more than calls. You're right, Dave, or John. Okay. So the right duration, I kind of mentioned this earlier on. Usually when I'm talking about strategies for selling spreads or selling premium, we're going to get out here and take advantage of this contraction in theta. But one thing that's nice about going into these binary events, when you get volatility pushing higher, starts pushing up, well, it kind of flattens this curve out a little bit more. And yeah, there are calls and puts on these, but what it will do heading into that event, you get into about 20 some odd days and this curve starts kind of flattening out because volatility is pumping up. And then you get into that binary event and boom, it just drops like that. It's more dramatic in a sense. So volatility is like blowing up a balloon, you know. It holds off that curve. So like as you blow up a balloon, it almost flattens out more, right? The flatter the balloon is, the more surface area it looks like there is, or the flatter it would be if it was like, say, laying on a table. And you blow it up and that curve kind of like flattens out, it seems like, synthetically in a sense. So that's what it is. And then you let go of the balloon and all of the air or all of the volatility comes out all at one time. All right. So and picking the right environment. We talked about this. This is what I was talking about, the high implied volatility percent. And if your platform doesn't give you this, let me see if I can pull up a real quick. This just so happens to be Pepsi. I did a earnings trade on this. I did the, what was it, the 112, 117 strangle yesterday. Took it off today. It did go and test that market maker move. $2 was the expected market maker move on it, and at one point in time it was through it. I just kind of waited till it went back up into my, it started trading up into 112 something midday, and that's where I got out. It was actually like 45 minutes after the open, and then it started, I guess, obviously it came back off. It settled 113. So it ended up being all right. But this is what I'm talking about with volatility crush. Boom. After a binary event, you get that crush. It's not a very good example of on Pepsi, but you will see this a lot of times afterwards. I mean, you can see it goes down a little bit, but it didn't have very high implied volatility. So how do you determine implied volatility? Well, you get implied volatility, put it down here. And the way that this math problem is to come out with a percent is you have a numerator and a denominator. And in the numerator, which is on top of the equation, right, you take where the current implied volatility is, which is 0.11, or sorry, 0.14, and subtract that by the low, which is 10. Okay, so we got 14 minus 10, that gives us 4. And then you take the high, which here is 21, so that's the 14 minus 10 is in the numerator. In the denominator, we have 21 minus 10. So we have 4 divided by 11. And then that percentage, you know, you divide 4 by 11. 4 divided by 11 is it's in the 36th percentile. So that's how you come up with that. Where it is currently, minus the low, and divide that sum by the high, which is 21, let's just say, minus the low of 10. And I'm rounding up just for ease of that. Did you get that, Dave? Or sorry, John? Can you repeat the calculation? It's where it is currently, which is 14 in the numerator, minus the 10, which is the low, which I'm just rounding right now. So in the numerator, 14 minus 10, and then in the denominator, you take 21 or 22, you might say, 22 minus 10. So that ends up being 4 divided by 11. That answer your question? Okay. All right, so let me pull this back away. All right, so we want high IV percentile. And you can figure that out if you don't have that TOS platform doing that. So theoretical move, $2. So another thing you can do with TOS, which makes it pretty fun, and I don't know how to do this calculation in my head and or on paper necessarily without going through a lot of work for the most part. But basically what you can do is with TOS is you can go up here and you can click on layout rather than single or delta and or volume or any of those. There's actually something in there. It's called theoretical price and mark. And what you can do is Pepsi on the 24th is when I did this. So I punched in the date, the 25th, said what if it moves up by $2, increases by $2, and volatility crushes by 30%. So I went on, ballparking from 26 or 27 to 17, thought, you know what, that's pretty close to 30%, so I threw it in there. So what we can look at for this type of scenario is, I'm telling you guys to go $2 outside, which would have put you probably around the 17 strike, which is what I ended up doing for Pepsi, and the 12 strike, if you subtracted it and go outside of that. So kind of rounding up and then rolling out. So I was able to get that 30 cents. I think I ended up collecting just over 60 cents for it. And the idea was if it moves $2 and the volatility crushes by 30, what are these prices going to be worth? And it's going to tell you at the end of the day what it would be worth for the most part. And volatility would crush down almost to basically zero. But the thing I want you guys really to look at is what if I would have sold the 16 or the 116 calls here, 59 and volatility crushed like that, I would have been in the money on a $2 move by 50 cents. I'm in the money by 50 cents and it would have been 40 cents, 47 cents. So I could have, synthetically scratched or made a couple of pennies, which, that close to where I did it, I would almost consider that a scratch. But I'm 50 cents in the money, and the premium is worth less than what I originally paid for it. And you will see that time and time again when you get that volatility crush like that. So you can play around with that. And picking the right underlying. I've been showing you JP Morgan, Pepsi, things of that nature. Picking the right underlying has to do with volume and open interest. And when there's a lot of volume and open interest in these underlyings, these bid asks get tighter and tighter. The reason being is there's so many people in there trying to get their bid on the market that these markets tighten up quite a bit. So my rule of thumb is any stock under $100 needs to have the bid ask, the difference here between the bid ask, to be less than 10 cents, anything under $100. Anything over $100, I basically say, move this, move where the last is and move it 3 ticks to the left, and 11 cents would be, for this example, how wide these should be, no more than that necessarily. So if you're looking at a $300 stock, we're kind of trying to get it inside of 30 cents or roughly right around there. If price goes way away from the short call, then what should you do? We're going to talk about that here in a minute, because that actually, I'm going to roll. That's actually next week's webinar. I'm sorry. If my calls go in the money, my short calls go in the money, and it's kind of blowing through me, and I'm not real sure it's going to come back, but it might. First step is to roll your puts and create a straddle. So you're going to basically roll it to the same strike or very close. The next step would be, if there's any time left, you know, like maybe 3 or 4 days, if it continues to go, I might even invert and collect more credit. So the idea with those puts is to collect a little bit more credit. Yes, when you invert, like for instance, if I was short these 15 calls, I had to roll up to selling these 17 puts because the market is trading up here in the 20, you know, around 21 or something like that, or maybe say 20 or something. Then I've locked in a loss in a sense. That tight, it might still be a profitable thing if it came back down, but what I'm looking for is to minimize the damage, continue to collect credit, even though I'm kind of, you know, if I came up and sold the 19s or something like that, I'm likely going to be locking in a loss on this trade. But if the market does come back then and lands inside of those two strikes, I've minimized my exposure and my loss potential in a sense. Yes, but if you take different days peak and lows. So back to the, you're talking about these different days. Yeah, you want to take the high and the low, but sometimes you'll see an outlier. Let's say, for instance, this was an outlier. You know, sometimes you will see a massive spike up. You know, maybe this, I don't even know if I can draw on this. No, it's not going to let me. You'll see a massive spike up that's just out of the blue. It is probably something that won't happen for another very long time. You see that actually a lot in, say, the biotech stocks, because they have a drug trial that's going to have their results coming out. A lot of times you'll see those spikes a lot bigger than the spikes in and around in earnings. So you can kind of discount that out, and for that matter, you know, then you would take, good point, maybe this was a drug trial on something and we would take this as the high. I usually don't discount the lows as much. But the highs you can discount because sometimes there's some kind of crazy outlying event that creates that situation. All right, so making sure we pick the right underlying, tight bid ask. You know, this is an example of Roast, which is Ross Stores. You know, a lot of people know of Ross Stores. They're around all over the place, but in that, you know, it's a $40 stock, and you can see these are sometimes close, but at the end of the day, they're pretty wide. It does have the high IV, has a nice market maker move, but you know, that bid ask is just a little too wide for most of these. So, and these other ones could be like one lots, and they're just making the market look tight. You can see there's not a lot of participation on this one. So kind of stay away from those kind of stocks where a lot of people know of them. You know, Dow Chemicals one where they have really wide bid ask, even CMG. Everybody's heard of CMG Group, right? Chicago Mercantile Exchange, CME, I should say. Chipotle on the brain, I guess. CME, Chicago Mercantile Exchange. They have a wide bid ask, and everybody has heard of them most likely. All right, know our exit strategy. So I like to cover these in the morning before anything happens, unless it's really kind of through me and I'm looking for it to come back, kind of like with Pepsi today. I thought it was just a little bit overdone to the downside. It didn't look like it was that big of a deal. A lot of stocks actually right now are coming out with decent earnings, but you know, they're pulling back a little bit because people are expecting these really robust numbers when we're at historical highs and the economy's not doing that great. I mean, it's doing okay, but nothing for anybody to write home about necessarily, but the stock market continues to go up. So I think we're starting to see a lot of pullback from that kind of thing. So with that, the pullback happened. I just kind of put in my bid and let it meld for a little while. If you watch the daily market commentaries, you know that didn't work out that same way with IBM. So a lot of you guys were having questions coming through there. Did I answer everybody's questions coming through there on some of that stuff? All right, max profit for the Strangle. The max profit is the net premium received minus the commissions. The Iron Condor is going to be the net premium received. The Iron Condor is the max profit is the net premium received minus commissions as well. It's whatever. Anytime you're selling strategies, your max profit is the premium. Now with the Strangle, you're going to have unlimited risk. But keep in mind with the Strangle, and that's the one I usually do, the reason why I do that is because I can get further out and away outside of the market maker move. So I have a higher probability of success in a sense. So the lower delta, when you're selling those lower deltas, those are high probability trades. When we do this Iron Condor, and when I pull up the actual live trading platform, you'll see that you actually have to get a little bit closer to the market. Otherwise, you're kind of incurring more risk than what it's worth for those anyway. But your max loss is limited. Now remember, anytime you have higher risk, you have higher probability of profit. Anytime you have lower risk, you have lower probability of profit. So it's a yin and yang. You have to give up something to get something in. To create that limited risk, we're going to have two possibilities of having max loss. Now, they can't both happen at the same time because the market can't split in an underline. So take your long call minus your short call, or just look at it like the width of that spread minus the net premium. So in an example I gave on $1, we're looking to collect 30 cents. Our max profit would be 30 cents. Our max loss would be 70 cents. Okay? Does that make sense? All right. So, and then our break evens, pretty easy. It's the short call strike plus the premium. So if we sold those 117 calls, I sold the 117 112s, right? So my break even is the net premium, that's 63 cents. So on the upside for Pepsi, my break even would have been at when the underlying was trading 117.63, and to the downside I was short the 112 puts. It would have been to 111.37, right? I do that math right in my head. So and then the break even on the Iron Condor would be that short call, whatever that would have been for Pepsi, probably would have been closer to like the probably would have been closer to the 113s on the puts and probably the 115s on the calls, I'm guessing, plus the net premium. And we would be trying to collect 30 cents, so add that 30 cents and subtract that 30 cents from those strikes. All right, let's get out of these things. I like getting into the platform much better. All right, so let's pull up the platform again. So XOM. So there's actually, the nice thing about doing this webinar on a Wednesday, usually I do it on a Friday and there's no earnings coming out the next day. So this we actually have some coming out after the close, but I kind of wanted to lean towards a couple of them that are coming out tomorrow afternoon because we wouldn't be able to put this straight on right now anyway. But we have Microsoft, Intel, Google, and Amazon, so some real fun ones that I love to trade coming out after tomorrow. And usually the way I find these out, you guys, is I go to Morningstar. I go to Morningstar, and I just like their calendar. They give everybody, you know, NASDAQ has one, Yahoo does one. It's kind of what you're used to. If you use a NASDAQ, you're going to miss the blue chips, so just keep that in mind. But anyway, so today's after the market, you would be able to see all of those, but you can just click on these. It's going to have them all shuffled by alphabetical. I click on the time so that I can get the before and after the market, and if you hit it again, it'll give you the aftermarket. So we can kind of scroll down to Google. You can see GOGL and Goog, Amazon, Microsoft's going to be a little bit lower, but it's nice. You can go through all of these, but you know there's going to be a lot of these in here that you know are going to have wide bid ask. I'm just going to skip over mine. I didn't even realize Starbucks was when I scanned through this the first time. So take advantage of that, and then you know, the other thing to remember to do is check the 28th for the before the markets and scan through those, and you'll see that XOM, Potash, Dow, and CME are having earnings. So it's a good website and it's free, so they don't pay me to tell you that. It's just that's the one I use. So for instance, let's look at this again where we can kind of flip through all of those things I talked about. XOM comes out in a couple of days. Its implied volatility is pretty low, so I would probably not look at this one. There's one of those outlier moves that we were talking about, John. For instance, I don't know what happened there, what that outlier move was necessarily, but going forward, I would probably pretty much discount that and kind of make that my high in my mathematical equation, because sometimes that can really skew the numbers and it always looks like it's really low. So that's why it's good to know that math problem too, so you can discount that outlier. As a matter of fact, for a long time, I think it was MOS, Mosaic had that. Like, yeah, see, here's Mosaic. Boom. I don't know what that is, that data point. Nothing happened around that. Look, there's no event going on, nothing after the event. So from there on, that would have been the time where I would pull that number out and make that my low, because this low is going to synthetically make this seem like, oh, it's above 50. Wolfman says do it above 50, do it above 50. Well, you'd be doing it above 50, and it's actually incredibly low implied volatility for that underlying, as you can see. So keep that in mind going forward. All right, so Mosaic was that one. So let's look at some of the fun ones, like did I just do Microsoft? Intel Corp has it, and I think they have Implied. We can even look at Starbucks. So it's above 50, and let's just look at theirs. So you can see this volatility crush happen there, volatility crush happens there, volatility crush happens there. All these other times, you don't know when volatility is necessarily going out, and it can be at 100% and continue up, and it's still at 100%. So this is, we know volatility is going to crush after this comes out. And how much do we think it's going to crush? Well, the market's saying right now it's at 58. It should be in there. So 49, and it's going to crush down to these Mays, which is 21. So that's over a 50% volatility crush. So the premiums are going to get decimated, which is the even better scenario. So we go 49 divided 20, what was it, 21, 22, 22 divided by 49, and you guys notice I round everything up. So it's going to crush by 56%. So we can play around with these numbers and go in here, see what's going to happen to our option montage. This is where I was talking about with theoretical price. Go in here. So let's say we were getting ready to set this up for tomorrow. You know, tomorrow we're in the day. We see that there's a dollar market maker move. We're in the day. We figure out what our market maker move is by adding these two together, and that's $1.20 times 0.85. So that's probably around $1 also, just doing that math in my head. And I closed my calculator, so I got to try and find it. Or did I just have my calculator up? All right, so if we do this at the money one, 37 is probably the closest. So let's just do it real quick. 120 times the 0.85 to figure out what I think our market maker move is, $1.02. So somewhere just over $1. So you can see they're all kind of in line with one another. So we would want to at least be outside that dollar move. So that would probably put us right here. We'd probably have to go inside of that for Intel, which I don't know if I'd really want to do. So I might get kicked to the curb right away. So, you know, in that where I'm like, do I really want to get inside the market maker move? Well, let's look at it. So stock moves $1. Let's say it moves up $1. Let me just make that a plus. I always kind of default to looking at the calls. I don't know why. I mean, I probably could look at the puts, but that's just something I do. We determined it was going to crush by over, let's say, 50%, right? Didn't we come up with 50 or 56% or something? It was 56% or something. I remember right offhand. So you punch those in, negative, and this is confusing. Volatility adjustment, well, some people would think you'd go to from 49, why isn't he punching in 21? Because that's the adjustment, right? This is actually volatility adjustment, a percent of the percent. So just keep that in mind. You got to figure out how much percent drop this percent is going to be. Could be confusing, but that's the way they do it. And boom. So we got that. It's got all our details in there. So I don't know if I'd really want to do it, even though I'm getting that big volatility crush. $1 outside of this, get those 30s, it's probably gonna hurt. So Intel would probably not have to move at all. So probably going to pass on Intel for that earnings for those very reasons. Go through all those steps within yourself. Don't just go and pick strikes randomly. Know what you're doing with those strikes, because then you know where your risk is, right? That makes sense. I got to go. Hope you got the recording. You got the recording. It'll be sent to you. Yeah, and watch it again, please. All right. Thanks for joining us. What? Called it? All right. So that's how we figure those things out with that. So we could look at one more because we are running out of time. Let's look at Amazon. Amazon. Fun thing with these is I do these Amazons and Google's a little bit different because they are big dogs, right? Why is this showing those theoretical prices like that? That cannot be right. So with Amazon, the market maker move is $31. We could do our little math problem here and do 18 plus 18. We get 36 plus 36.50. Let's call, actually it's in between there. It's going to be like 19 and let's say 19 and 18, so 37. So $37. We got a $37 straddle times 0.85. And I'm coming up with 31.45. So you can see that they are all generally very close. So it's just an easy way to do it. And they don't always give you these. So it's good to know. Tall tail curve. Yeah, that's what you're talking about, the skew for the puts. Yeah, definitely. Actually, it almost looks like it's skewed to the calls because everybody thinks it's skewed to the calls. It's because everybody thinks Amazon's going to continue to go up, which they probably are. So it's probably not a bad thing. Everybody's pumping up these calls. So anyway, but with this, implied volatility percent on this is, oh, it's over here, 59.95. So that's another thing, you guys. I always throw over here, go over to the gearbox, type in IMP, and it should basically say implied volatility percent. Throw it in your watch list because that's an easy way to see. That's the first thing. I don't even look at these stocks over here, but I know these are the stocks I like to trade or will trade. And then just run down these lists like this. I don't even know what the stock is until I, start clicking on IV percent, make sure they don't, or make sure they have earnings or whatever the case may be to start setting up strategies. And then I look at the stock to see what strategy I'm going to do. But high IV, I always do selling strategies. Low IV, I do buying strategies. All right, so they have the high IV. Let's go into Amazon, and with these massive high flyer ones, $31 market maker move. The beauty in this is I would probably start looking at double the market maker move, so $60 outside of it. So I'm going to probably have to go with a lot more strikes. Probably didn't need that many. So we could probably look at almost $60 outside. That puts us at 70. You can still collect a nice chunk of change out there on a 9 delta, which means, you know, we talked about the standard deviation. This also tells you the probability of Amazon settling 1 penny above, at that being $970.01. That's the probability of it settling there. 1 penny above, so 1 penny in the money. It's a 9% probability. That's pretty low. One thing to note, though, thing we used to use on the floor was 2 times the delta was the probability of being touched. So that means the market comes up and touches you, it tests you in a sense. It's 2 times that, so it's almost an 18% chance that it'll come up and touch you. So that's the other thing when I was talking about with like selling these 16 deltas and stuff like that. You know, it's only a 16% chance that this is going to settle in the money. It's a 30% chance that I could get tested on it. So that's another way to, you know, hold your salt, if you will, keep your powder dry, I should say, when you're talking about probabilities. But to get that third the width of the strike that I was talking about, we're going to have to go inside the market, make a move on this, and we would have to sell like probably the 36 delta is usually kind of, you know, 31. What did I come up with? 31, 32. But it's with the calls being like this, we can start with that. 31s, hold down the control button. We got a $10 wide, or actually a $5 wide. So that's well outside of that. So that, because these are all pumped up on the call side, we could probably go out a little bit further and do another $5 wide, 77 cents. So it's going to have to play around somewhere in between there. So we want to at least collect on a $5 wide about $1.50. So you can play around with that until that happens for those. But keep in mind, if I'm doing those 45, so let's check the 40s just one last time. 45s, where if I knew the 45s. So $5 wide, $1.50, that would probably be the strikes. But remember, 25% probability of being in the money at expiration, or a 50% probability of being tested. You are also trading 940, which 31, that's right there, lockstep, in line with the market maker move. So if you thought that it was, so, and then you know, for the straddle or for the iron condor, then I'd have to go down here and try and do the same kind of situation where a $30 drop would bring me to somewhere in around and about 870 or 880. So let's just look. So I'd hold down the control button, sell these, go $5 wide, and $3. So that's pretty close, you know, getting in that third the width of the strikes for those each, to be able to be able to take care of that. Does that make sense? But with Amazon, for me, I'd probably rather do the strangle, and I'd go out here probably to this 9 delta and be at these, basically the double the market maker move, and that's a very rare occurrence. So I'd probably just, it's giving me a, where's my pop-up? Because I tried to add another leg on accident. Give me a problem. All right. Where's my pop-up? All right, does that make sense for everybody? Why aren't you going to do this? Should have given me a pop-up saying I was doing something wrong. Oh, you're annoying me. All right. Anyway, I guess it's not going to let me do it. So you guys, take advantage of this. That's all I got for you guys today. That's pretty much it. It looks like people are losing their questions. So anyway, this is the deal that we're giving away right now, and it's an amazing deal. It's for $7. You get a free month of premium membership, which gives you absolutely access to everything. This is for this link right here. You can either pause it if you're watching this on tape, or right there in the chat box there's a link to it that makes it very easy. They actually have, I believe, the wrong one. I thought we were doing this particular one. So I'm going to override somebody because that's what I thought I was told we were doing. Right? So anyway, oops, where are we at? Right there. So anyway, it's $7 for this month. So I threw it in there. And basically you get all the daily market commentaries, you guys, which basically I go through every single trade. I talk about the earnings trades. I talk about how I'm managing those losses, how I'm managing any kind of risk. I'm also talking about when I'm putting them on, why I'm putting them on, if I find support resistance levels, if I talk about economic, geopolitical, market stuff. All throughout those are like quick 10-minute videos. I try and keep them lower, but I have a tendency to talk a little bit long, as you guys can tell with the webinar I'm going over. And then you also get over 50 videos of options trading workshops. So like if you guys enjoyed this, if you think you guys have learned anything at all from this webinar, for this price, you can't even get lunch for it. So that's a bargain, and I'm sure you will make that up in just the earnings season alone. If you've learned anything at all from this webinar, even if you've learned a little nuances about the delta in this webinar, it's worth a $7 deal, and you're getting a full month of it. And I also have other workshops where they're a little bit shorter than the webinars, that you have access to that. You also get access to me if you are a premium member. If you have an issue where you have a trade that's going on, a lot of you guys I know have reached out to me on trades that have been against you, and I've talked to you about how to manage that kind of risk, or how I would at least manage that kind of risk. I can't tell you how you should, but I can tell you how I would go about it and stay mechanical. You know, that's one thing I learned about from my psychology degree, is to kind of get that emotion out of it and stay mechanical. If you can stay mechanical, stay with the probabilities and things of that nature, you will be much more successful. So it's a great value, and you guys should all take advantage of that, because that deal is probably not going to be around much longer. And because I can't pull up my PowerPoint anymore because my platform froze over it, I'm just going to have to say thank you and can't show you that platform page. So I want to thank you guys all for participating in this. Future webinars, we're going to be drilling down on other option strategies and different methodologies. If you guys ever have one that you want me to cover, reach out to me at trading@protraderstrategies.com. Also, if you have any questions, you can reach us at 310-598-6677, and we'll be happy to talk to you. If they can't answer your question on first touch about some of this stuff, they'll send you over to me and I can take care of you, all right? All right, that's all I got for you guys today. If you can't take that, take it easy. Thanks, Andrew. Thanks. I see a couple questions popping up. I'll answer those here in just a second. Take care, Greg. All right, so quick couple of questions. One, for Strangle, 5 strikes wide, credit, a third the width. Yeah, so for iron condors, twice this. Yes, correct. So yeah, so you want to be, especially for earnings. Now you can go a little bit further out on that, and you know, I like to at least, you know, the nice thing about that iron condor is you're collecting a nice fat premium. You know, when I'm talking about for regular strategies for the iron condor, I kind of still stick to that third the width of the strike as well. So that can still be a part of that, where you can go a little further out and for a $5 wide still collect and lower that to about $1.50. But that is my threshold. I'm not ever going to go lower than that, especially for earnings. Does that make sense? I probably should have covered that a little bit tighter. Also, the in the normal distribution curve, one standard deviation is up or down in the call and put area, right? Yes. That's one standard deviation is that 16 delta. I saw some people asking questions about that, but I didn't want to confuse everybody else. The 16 delta is that one standard deviation move based on that bell curve and the percent probability of being outside of that area on the bell curve. That answer your question, John? Great. All right, you guys, have a great weekend. Take care.